Good morning and hello everybody, and welcome along to the October market commentary for Portal Asset Management and the two funds, the Radiance Multi-Strategy Fund and the Portal Digital Fund. My name is Deryck. I am the CEO of Portal Asset Management, and with me today, like always, wearing the same shirt nearly as I'm wearing, it's Galton, the CIO of Portal Asset Management. Greg, hello.
Good morning, Deryck. How are you?
Yep, very good. And so an extraordinary month for us to be able to discuss. What we're going to do first is we talk a little bit about the market and about some of the sort of gossip and discussions that are happening in regards primarily to Bitcoin's price and its position in the cycle and have our view on that. Then we'll talk about Radiance's performance during this period of time and where that sits in the forward projections of Radiance. And also, we're going to talk today about the Portal Digital Fund and the process that we're going through in pivoting that Portal Digital Fund to higher return, more systematic, less market directional funds. But to start with, of course, Bitcoin has dropped substantially from its all-time high, which it touched for a short period of time, and it's now sitting down in the low 90s, a position that probably surprised many. Your views on that, Greg?
Yes, I guess going back to the start of October, Uptober as is commonly referred to. It has historically been the start of a good quarter and historically been a very good month for Bitcoin. And look, it started off relatively well in that regard, but then you had President Trump decide that he was going to attack China in terms of the tariffs, and tweeted to such effect on a Friday afternoon, which sent equity markets into a tailspin, and also crypto markets. We had an unprecedented level of liquidations in the market over that weekend of the 10th of October. $19 billion of liquidations. The number's probably actually higher than that. We don't really know the true number. That's at least the minimum. And that was really a failure in the infrastructure, primarily the centralized exchange that run by Binance had some issues with their not honouring stop losses. So basically people that had used perpetual futures to initiate positions using some form of leverage, and they had with the market moving down so quickly, it actually resulted in some very, very strange price action and people being liquidated in their positions when they didn't have any stop losses, and that sort of really sort of flowed through for most of that weekend. It did wipe a number of the OG degen traders out. It didn't really affect the normal retail market at all. It was really just the traders that were using perpetual futures. So look, that's interesting from our point of view because we also use perps. We use the Deryck exchange, and we were pleased to report that the Deryck exchange functioned perfectly during this period. They did not have any infrastructure issues, and the fund didn't have any impact whatsoever from that period of market dislocation, which is very reassuring and pleasing to see.
Yes.
We've done a lot of work on the infrastructure, and that was vindicated by the way that the market handled that period. So that's that sort of started off that sort of weaker month. So October, instead of being Uptober, was Notober. So the broad market CCI 30 was down just over 11%, and Bitcoin was down 4% during that period. So a little bit of a sort of increase in volatility, mainly driven by that sort of downwards price action over that period. So quite an uncomfortable time to be in the markets for a few people, including some of the major market makers, but most people got through it unscathed. But the sentiment is it was I guess a sort of turning point in sentiment. We talked about before Q4 usually is a strong period for Bitcoin. Expectations October would be good, and what we've seen really is concerns over now, as we speak at this moment in time, over what the Fed may or may not do in December, whether there actually will be a rate cut coming. The odds of that are slipping, and a lot of risk on assets globally have been sold off recently. So crypto is not immune to that sort of sell-off as well, and really perhaps has led that move down. It's certainly been the more volatile move down. So now we're in a situation in November, as you said, where Bitcoin has fallen effectively around 30% plus from its recent all-time highs, around the low to mid 90,000. It's sort of, we're probably going to talk about it. It's led to some discussing where we are in terms of the 4-year cycle, and that's probably worth focusing on.
Yes, look, it is, and let's focus on that. But before we do, I guess there's a couple of things we need to say, and that is that yes, we had a few people approach us, and very quickly, within 24 hours, we sent an email out updating saying the fund hasn't been adversely affected by the sudden overnight downturn, short of its position of price. And also people often wonder, the fund actually generates income through its dips. The dips are annoying, the dips are reporting some blood colour on a monthly basis, but that's where we generate incomes, because the rise provides capital growth, and the rise provides volatility, and the rise provides the generation of more Bitcoin in the form of income generated. So we'll talk about that shortly a bit more. That just simply makes this process a little bit more enjoyable, a little bit less painful for us, but we're always focused on where is the market going in longer term. People over the last 12 years have been attuned and trained to look at 4-year cycles, and they even say the date associated with those 4-year cycles. But in this realm, there's nothing truer than the statements, saying that past performance is no indication of the future performance, because that cycle is now different. And I think no matter what the pros and cons are in regards to where we are in that cycle, everyone at least acknowledges that the cycle is now different. Maybe cover those parties or views of why we might be at the peak, and those that have said this is just an interim period of time, and why the cycle is not the same, because it's important to understand, Greg.
Yeah, absolutely. So there's always been a view that the Bitcoin price, and obviously the Bitcoin price drives the crypto market, so you focus on Bitcoin. The Bitcoin's been driven by a 4-year cycle that's been driven around its halvings. So as you know, every 120,000 blocks, the block subsidy for Bitcoin halves. And that occurs roughly every 4 years. So it started at 50 Bitcoin per block, down to 25, 12.5, 6.25, now at the 3.125 Bitcoin per block mined. I think, and I think people have become used to this 4-year cycle as sort of 1 year of euphoric bull market, period of Bitcoin winter where the Bitcoin price drops anywhere between 50 to 70% for a period of 12 months, and then a period of 2 years where the Bitcoin price just kind of goes sideways. And I think early on you could make the analysis that the halving cycle was important, because obviously when you go from 25 Bitcoin per block to 12.5, that's a big move down. But when you're going from 6.25 to 3.125, it's less important. And then the next halving will be 1.625. So it becomes less and less of an effect. But what I think people have done is they've conflated that, and they've thought that the 4-year time cycle was driven by time. We don't believe it is. It's been driven by liquidity. And it's just so happened that those liquidity cycles have coincided with the Bitcoin halving cycles. So we think that the easing cycle is probably not yet over. Regardless of whether the Fed cuts rates in December or not, we think there will be more cuts next year, rate cuts out of the US Fed. Obviously, there'll be a replacement chairman by then. Trump's sort of made that very clear that he wants to see US interest rates lowered, and he wants to achieve that by putting someone in there that will do what he's told. Even though as we know, the Fed should be independent. Yes. Of the government, but anyhow, let's just ignore that for the moment.
So we just got to trade within those parameters.
Yeah, within those parameters that we know about. So yeah, I think the liquidity cycle is not over. Global money supply is continuing to grow unabated. I still think you're seeing periods of economic weakness in China. They're still cutting rates and putting money, easing monetary conditions. You've also got the Fed ending quantitative tightening at the end in December. That doesn't mean they'll move to QE necessarily, but it is an end of QT. I think if the economic situation in the US deteriorates next year, which there is certainly some risk of happening, then you could see more rate cuts and also quantitative easing. So that sort of liquidity environment we think will be very positive for risk on assets, especially Bitcoin.
Yes.
So yeah, we don't think that we've seen the cycle high this time around. We think we're probably still mid-cycle. 30% drawdowns in a bull market are perfectly normal. It's what we've seen every single time. And we've been kind of used to this sort of slow, steady rise and Bitcoin's volatility falling. And it just reminded us that it is still a volatile asset. And we obviously benefit from the volatility, whether it's upside or downside. Obviously, we're in a situation at the moment where Bitcoin is down. We obviously have leverage to that in terms of where Radiance, the fund, operates. And so, for the month of October, Radiance was down about 10.4%. 10.4%, and the Bitcoin price was down around 3.9%. So we did have slightly more leverage to the downside there than we normally expect, but that's just because the fund is buying the dips. And we'll continue to do this. And that's a key part of the strategy, that every time we enter a valley in terms of a price dip, the mountain that we rise to in the next period when the price recovers is always higher. So the strategy does benefit from being able to buy Bitcoin during the dips.
So let's just take this moment and put up the graph and see what that's been like in the previous 2 years. Yes, a rapidly growing market, but the dips are well reflected. So we've brought the graph up here that outlines the 2 years of in-house trading, real money that we did during a period of time which was an upward market. But it does show well the dips, doesn't it, Greg? What happens after?
Yeah, exactly that. Because we use the perps to synthetically cover the call positions and basically hedge that position. We do have that exposure to the downside movement in the Bitcoin price. So you can see there the valley that was created by by the dip in the Bitcoin price. But then the key point to really emphasize is that the mountain on the other side of the valley is always significantly higher. And really that's because the strategy loves the dips. The strategy buys into the dip, generates not only premium income after that, but also capital growth. And you can see that really solidly in September as well, when we saw another price drop into the valley. Then the mountain on the other side was significantly higher over that period. So that's really what we're trying to emphasize here, is that the short-term volatility has an impact on the NAV, but it's the strategy buying the dip, and that's really what you want to be doing with Bitcoin. Is you hear people talking about it all the time, buy the dip, and that's what the strategy does. That's what the strategy is designed to do. It primarily focuses generating premium income, but it also is able to generate capital growth, and it steps into the market when the Bitcoin price is lower. And that can mean that we have a slightly higher leverage to the Bitcoin price on the downside than we normally expect. But that's just it just creates the opportunity for us, and we take advantage of it because we know that when the price recovers, the returns that will come in terms of the NAV will be significant within the fund. So that's really what drives that.
It's interesting to note here too how the compounding effect in these 2 very good years substantially separated us from Bitcoin. Now this is Bitcoin's down here. In this particular case, those 2 years were very buoyant years for this strategy. And Bitcoin's down here. This is a MicroStrategy in a sort of leveraged environment it was operating. And this is NVIDIA, which is an outstanding performing. And for the gold buffs, we just couldn't help but put that in. This kind of virtually flat line down here, everyone's very excited about gold's growth, represents gold. So by comparison, a good performing strategy should outperform that. And you also see that then in the kind of in the shorter term, how the strategy does move itself away, but in the dips comes closer to where Bitcoin is actually on its designated period. And so it takes a while to see that compound and step away, but you can see the effects of what it can do. So a great example of the fact that you've got to look at the short term, what perceives to be pain, but in actual fact is our opportunity to generate income. And we often refer to this as it's an arbitrage of time. So the short term is when this high volatility occurs. But for investors that are investing for the 3 to 5 year period, it's irrelevant because it's just the short term. For us as people that are as managers that are generating income, these periods of time are essential. We actually want the dips so that we can have the upside capital growth and income that we can generate. Is that fair to say, Greg?
Yeah, absolutely. And we don't do this outside of the risk management. That's the most important piece to the whole strategy, is that you need to know that you have your downside risk protected during these dips, and that's crucial for us. And we make sure that we do that first of all. Even any new Bitcoin that we get coming into the fund, we immediately take that insurance put position on that Bitcoin coming in. You can't be buying the insurance after you've had the fire, right? You've got to buy it beforehand.
Yeah.
So we're buying it whenever that Bitcoin comes into the fund, because risk management is absolutely crucial with any sort of derivative strategy. We make sure that we don't have any sort of adverse outcome with our perpetual exposure. Yeah, that's the key. So that's why we're comfortable with the dips and buying into the dips, is because we have that risk management in place.
Yeah, very much so. It costs us. It pays away and it impacts on the return. But ultimately, the return is all about the generation of income of Bitcoin paid as an income, but accumulated over that period of years. And it needs to be understood what it is, and it needs to read on the can the same as what's inside it. And so therefore the view now is, where are we up to in the cycle? Now, we've always looked at December 31, 2030 as a date that is broadly 5 years away. That is a strategy for Bitcoin holders or investors in this Bitcoin strategy, so that we look at what we want to achieve. And we've mentioned numerous times our goal is to achieve X times the number of Bitcoin over that period of time. And a big part of that projection of, or we can say it is 7X Bitcoin over that period of time, is the fact that we're expecting periods that are going to generate limited or no return. So we're expecting a Bitcoin cycle to occur, and that it to be quieter during that cycle when we're generating smaller returns. But generally, our view is it's not now.
Yeah. Yes, I think the cycle is different now. I think it will potentially get extended, so it's no longer a 4-year cycle. Maybe it's a 5-year cycle, primarily driven around that liquidity that we talked about previously. But I think also, and we've talked about this numerous times, is the fact that the institutions are now coming to Bitcoin en masse. So you're seeing people allocate a portion of their portfolio towards Bitcoin within endowment funds. For example, Harvard is now allocated to Bitcoin, and I think actually trebled its position recently. You're starting to see Trump has allowed individual retail investors to hold alternative assets within their IRAs and their Roths. Yes. Which means that they can now access Bitcoin, where previously they weren't allowed to hold it within those superannuation style retirement accounts. You're also starting to see corporates considering having Bitcoin on the balance sheet as a hedge against currency debasement. So that, currency debasement, it's the gold bugs have been talking about this since the sort of the around the GFC. That was really one of the defining moments in the white paper, the Bitcoin white paper, was Satoshi Nakamoto really sort of highlighting the fact that the governments just continue to bail out the banks by printing money, and the sort of the debasement effect that has on everyone's savings. It's a hidden tax. It lowers everyone's savings. So that debasement view now I wouldn't say it's mainstream, but it's become a hot topic. So now even the large investment banks are talking about it. JP Morgan put out a piece recently about it. So yeah, it's becoming an interesting topic. So people are starting to look at Bitcoin as a store of value, digital gold, that they can prevent some currency debasement occurring. It's inflation plus, and we know what inflation does to purchasing power of fiat currency. So a number of people are coming around to that view. You've had the increasing growth in digital asset treasury companies, which I think is a bit of a double-edged sword, because some of these entities aren't that smart about how they're doing things, and they run the risk that once their MNAV falls below 1, the question gets asked, do they have to start selling their Bitcoin? So we'll see what sort of impact that might have going forward, and if the price continues to weaken. But I think we still will see those institutions and those investment houses that are making that decision. It typically takes them 2, 3, 4 years to be comfortable with the asset class, and we've really only had the ETFs for 18 months. So everyone is sort of highlighting at the moment the strong outflows from ETFs. I think a lot of that's really been the early adopters, people that went in there and played around, the hedge funds that were using it for the cash and carry trade. I think that they're probably exiting. Whilst the true investors that are coming in now will be long-term hodlers of Bitcoin. They're not going to be trading on a day-to-day basis. If anything, it's creating the opportunity for them to get in at a better price than, paying $125,000 per Bitcoin. They're paying below 100,000. Mm-hmm. That's creating the opportunity for them. So, yeah, I think the cycle, you got to be careful that this time is different. Are the four most dangerous words in finance, but we certainly think that there's a good argument to suggest that the cycle has changed.
Well, I mean, there are some indisputable facts, and the indisputable facts is the institutions are here at a level that they weren't before. Fact, the ETFs are here at a level they weren't here before the previous cycle. And so, fact, the governmental and corporate investment level is now here at a time that wasn't before. It was retail driven before, and what everyone needs to know about retail driven is that retail guys, that tragically buy at the top and sell at the bottom. I mean, that's what happens with retail. They tend to, take the exit of what the professional investors do, or the whales in that case, and then they panic, and then they sell out, and there's no other buyer. There's no buyer of last resort, so you get extreme volatility because retail just panics and runs. Whereas because they feel they can't afford the loss. Whereas the big institutions go, it's just it's a period of time, it's a dip, and we're trading for the future. That psychology is very different, and that's why we're confident the dips will be nowhere near as aggressive as they were in the past, because of the fact there are buyers of last resort. That's our view. And in regards to the current status, that view is more associated with the Bitcoin halving becoming so much less relevant, due to the demand exceeding the amount of Bitcoin produced every single day, and the cycle so much more dependent on M2 money flow. And so we're really then now looking at what's M2 money flow doing, and our view is generally that M2 money flow is going to pick up. In other words, there'll be quantitative easing again rather than tightening, and that easing is needed because the economies in the US are softening considerably. So all that being the case, doesn't make sense that it's an all-time high. I think, is that fair to say?
I think so. Yeah, I think so indeed. So we'll see how things pan out. You obviously hope for the best and plan for the worst.
Yes.
But I don't think we've seen the top this cycle yet. So we'll continue to travel along.
Terrific. And by the way, we're not alone. If you Google or do your own research, you'll see so many advisors in the space, the high-end commentators with the same view along the way too. So the Radiance position, Radiance is down for the month of October, and it's part of its strategy. It expects these downs. It's also expecting to generate income as we return to that all-time high, when we can see the reflection of the income that we've generated over the last 10 months now coming to fruition for the holders. Even then, the holders are holding for a longer period of time than just 12 months. Now, Portal Digital Fund. A Portal Digital Fund was established in early 2020, and with the intention of being able to generate returns at lower volatility than the CCI index, CCI 30 index, and it did that by having long position funds, momentum funds, and market neutral funds. And broadly, it's achieved its 25% return per annum, or close to 24.6, I think it is, since inception. However, circumstances have changed, and we have commenced pivoting that fund, and we're well and truly in that process. And we're pivoting primarily because we think Web 3.0, which will be tectonic and we think bigger than Web 2.0, is taking time and will take some time to evolve. But what we do know at the moment is the market's young, the spreads are wide, the volatility is high. And so we do know for a fact income can be generated out of that. And Greg, I think that's what we're looking at, continuing our deployment. We've already deployed to 2 funds that are more systematic driven, less dependent on market cycles. Would that be fair to say?
Yeah, certainly. I mean, a systematic approach, and taking advantage of volatility. Definitely the pivot that we've made to those two funds, I think that's how they would be characterized. And we are looking for those sort of funds or strategies that generate uncorrelated alpha in a non-directional environment, so they're not relying on the market beta to generate returns. And we're starting to see, a lot of these traditional, I would call them traditional style hedge funds, the long-only investors that have tried to pick tokens, they've really struggled because Bitcoin has been such a strong outperformer. And it's an unusual asset class. Not many asset classes out there where one asset is 60% of the total market capitalization of the asset class. And that's very unusual. So by definition, a lot of the fundamental long-only guys are underweight Bitcoin. Bitcoin has outperformed most of the tokens over the past 4 years. Bitcoin's dominance has gone up. Yes. So that highlights that to everyone. So that traditional sort of long-only exposure, even long-short, because the betas of a lot of these tokens are so incredibly high that you can struggle to find the right tokens to short, and then you can have something happen and completely unpredictable, and that token can be up 100% in the space of a week, and you short that token, and it's very difficult to sort of wear that sort of underperformance. So what we're seeing now is we're seeing an emergence of new strategies emerging. AI and large language machine learning models are really helping in pattern recognition and generating some alternative products. And look, all of the crypto stuff is all on chain, so you can track token releases, you can track what token founders are doing, you can track what smart wallets are doing, and you can preempt them. You can look at what sentiment is on X, formerly Twitter, and you can almost predict the future with maybe only 5 minutes into the future, but that's all you need to be taking a position. So we are looking at some of these funds that do employ the new age, let's call it new age, artificial intelligence, pattern recognition, machine learning strategies that are very different from what you've seen from traditional hedge funds. And we're looking to deploy to those. Now, we expect the returns from those to be greater than the returns that we've been looking for in Portal Digital Fund. That will come at a cost, though. That will mean more volatility. You just can't have risk without return, or you can't have return without risk, right? Some people do try to achieve that, and it is, if you're trying to target 20% per annum with low risk, then those funds are out there. But I don't think that's really what people are looking for in Portal Digital Fund. And we're looking to do better than that, and looking to targeting 30% plus returns, and letting the volatility sort of increase up a little bit from what we have done in the past. It's a pivot that we feel that we need to make, and we think the one that that the holders should support, and it should make the fund more attractive, we think, going forward, and potentially get new investors into the fund.
Very much so. And I think it's important for people to understand that short-term volatility, like radiance, generates your return. And that generates your returns for your longer-term holding, your 3 to 5 year holding in the fund. And it's also important to note that unlike, say, long position funds that might put a punt on a variety of tokens, where those tokens might take years to recover, when you're doing this kind of trading, you can be potentially down, in Radiance's sake, 26%, and you can be up 30 and 40% the following months. And so recovery is very fast in this strategy. So that's part of what we're looking at. We don't mind the volatility as long as the recovery is there too, and that returns at that same sort of pace. And then volatility should be looked at differently to what it might be looked at with, say, equities, where the 2008 crisis took 5 or 6 years to recover. That's volatility that is not worth having. Mm-hmm. So by all means, everybody that is interested in either of these strategies, that is both an investor or considering it, and that would like to learn more or engage or discuss with us, we're always available for such discussions. Confident in the direction that the funds are taking. Very pleased with the opportunities we're now seeing with the Portal Digital Fund and the offerings that we're reviewing. We've deployed to 2. We're going through the process of liquidating and deploying to others, and we'll keep the investors up to date with that. And We know that November has been a tough month also as far as the screen perception of NAV. Yet again, it's a month of opportunity for us. So we'll give you an update on that more as we enter December. And for now, goodbye, everybody. Thank you for listening. Bit longer today than normal, but we hope that has been useful to everybody. Thanks, Greg, always.
Thanks, Deryck. Thanks, everyone.